Okay, so we're going to finish up chapter 7 today. And I thought we'd just start right here and just review these two kinds of discounts. Trade discounts is where we bill the customers for less than what's on the regular sales price, and we record the sale at what we bill the customers for. So not the sales price that's listed in the catalog, but what we actually charge the customers, okay? And then in cash discounts, we offer cash discounts so that people will pay faster, and we can use either the gross method or the net method to record the sales price and the accounts receivable, either the gross method or the net method. And gross and net refers to what we're going to record the accounts receivable and sales revenue at. Okay, so see, under the gross method, the sale is recorded at the gross amount, which in this case is $10,000. And under the net method, it's recorded at the net amount, which in this case is $9,800. Now, how did we get the gross and the net amount? It's 2%. Okay, see the 210, net 30, 2% is what they're allowed to take off. So 2% of $10,000 is $200. We're taking $200 off of the $10,000. So if they pay within 10 days, they will get a 2% discount. Now, at the time that we make the sale, do we know if they're going to pay within 10 days? No. So we don't know. We don't know whether they're going to take the discount or not. Most people end up taking the discount, to be honest, but we just don't know. So, but we have to choose one or the other, gross or net. Now, when they actually pay, that's when we know if they have paid within the discount. If they pay in the gross method and they take the discount, then we're going to subtract the discount. This is the discount amount. We subtract the discount, sales discount. See how sales revenue is a credit, sales discount's a debit. So this is kind of offset our sales to where our net sales amount is $99.20, right? So this is net sales. Remember on the balance sheet, on the income statement, sales less allowances and discounts and that kind of thing. Do y'all remember that from the last 2 chapters ago? All right, so but if we use the net method, we record the sale net, and then if they don't take part of the discount, see, they took part of the discount, the 80, but they didn't take this part of the discount, 120. So they did not take, so in this case, this is sales, and this one is sales discounts forfeited. So this is added to it, so the net amount is still $99.20, okay? So it works out the same no matter which one you choose. We're going to work a problem on this so that, maybe that'll... But yeah, do y'all see do you see that kind of makes sense? Okay. All right. And these are the journal entries for another problem like this. Let's say we sold $2,000 worth. If we use the gross method, see, it tells you in the problem we're using the gross method on this one, and the problem's going to have to tell you. So if we use the gross method, then we're going to record the accounts receivable and the sales at the full $2,000. And then when they take the sales discount or not, then we'll record the sales discount if they pay in time. All right? Okay, but now assume they use the net method. They record the sale as if they were going to take the entire discount. And then when they pay, then if they do pay within the entire discount, then we just have that entry to cash and accounts receivable. All right, so what do you need to know here? How to make these journal entries. Okay? Need to know how to make these journal entries. Okay, if they don't pay within the period, then they'll have a sales discounts forfeited account. Okay, so let's see what page we're on now. Okay, so we're on page 352. And in general, accounts receivable, some people don't pay within a month. Sometimes it takes people a month, 3 months, 6 months, 8 months to pay their bill. So in point of fact, you might say, well, when there's an extended period like that, it's almost as if we're giving them some kind of interest-free loan until they do pay. But in accounts receivable, we just ignore the interest, no matter if it takes them a year or 9 months or whatever to pay it, because overall in accounts receivable, this interest is considered immaterial. So we just ignore, for short-term receivables, we ignore the interest. So that's what non-recognition of interest means. We're just going to ignore the interest. We're going to assume that it's okay. There's no difference in the present value of the fact that they paid it over an extended period. Okay, so now let's look at how accounts receivable is on the balance sheet. And what we're looking at here is the allowance for doubtful accounts. So you remember the allowance for doubtful accounts is a contra account that comes right after accounts receivable on the balance sheet in current assets, right? Okay, so it offsets accounts receivable, and it normally has a credit balance where accounts receivable has a debit balance, okay? So this is what it looks like. Cash, accounts receivable, less the allowance. So we come up with a net amount for a net receivable, right? So the question now that we're going to talk about is how do we come up with what should the allowance be? So we've always just, well, there is an allowance account, but how do we come up with the allowance account? And what is the allowance account? So the allowance account is kind of our estimate of how much of the total receivable is not going to be paid. Somehow we have to estimate who's not going to pay us. Now, so I worked for this one company where everybody paid, always. So there was no allowance account, right? We just had accounts receivable, and then everybody always paid, okay? So not in every company, like maybe you'll be lucky, work for a company, there's no allowance account. That's great. But in most companies, not everybody pays their bills. So in some way, we have to estimate who's not going to pay. Now, why do we do this estimation? Because we want to match our estimate of who's not going to pay, which is an expense. When these people don't pay us, it's kind of reducing our sales, right? So we want to match this kind of expense of who's not going to pay with the sales and put it in the same period. So we're not going to wait and see if they pay, because that would put that expense in a future period. We want to put it in this period. So we somehow come up with an estimate of who's not going to pay and put it in the current period if we can. Okay, so this is just showing that you could either subtract the allowance and have it shown separate, or you could just show accounts receivable net of the allowance, okay? So when we make a sale, so here's our accounts receivable and allowance. When we make our sale, our entry is to debit accounts receivable and credit sales. So that's where the sale goes, there on accounts receivable, adding to our accounts receivable. And then if we collect some money on that, then that collection, if we collect money on our accounts receivable, it goes as a credit to accounts receivable. So this is just kind of showing you what the journal entries in accounts receivable look like. Okay, and then what if we estimate that we have a bad debt, or we estimate that somebody's not going to pay, then this is where we put our estimate to increase the allowance account. Okay? And our debit is to bad debt expense. So bad debt expense is an expense on the income statement, and then we also have this allowance credited on the balance sheet. Okay, now we find out that one certain person, we find the individual who isn't going to pay. So like this $15 is our estimate of, surely there's somebody out there. We don't identify specific people, but we come up with an estimate of a number. But when we actually find, well, gee, this guy hasn't paid us for a year or whatever, I'm pretty sure he's never going to pay, then what we do is we write off his account, okay? We're going to write off his account. So we have a list of accounts receivable. All these people owe us money. If we're pretty sure this one guy right here is not going to pay us, then there's no need to have his account in accounts receivable. We just want to take it out so that accounts receivable doesn't build up and up full of a bunch of deadbeats. Do you see what I mean? You don't want a list of deadbeats on your accounts receivable. You just get rid of the ones that aren't going to pay. So this is how we do that. We're going to credit accounts receivable to write it off. So we're taking him out of the list of $500. We're going to take him out, and we're going to take him out of the allowance. So in effect, we've kind of identified one person out of our list of people that we estimated. This $10 is one of the guys that we estimated is not going to pay. All right, so do you see how that goes? These journal entries, you need to know how to do these journal entries too, okay? So this chapter, the journal entries are becoming important. Okay, now let me just say, if this guy, they don't have this on this slide, but it is in the chapter, and I can't remember if it's on another slide. If he subsequently, on page 365, if this guy, this $10 guy, if he gets religion, let's say, and decides to pay you, a year later, he's all of a sudden, maybe he wins the lottery. Now he comes back to pay your $10 debt, right? But you don't have him listed in accounts receivable, right? So what do you have to do? You have to reverse the write-off and then record the fact that he paid, okay? So if he eventually pays, then we're going to reverse this entry. We'll go back and debit accounts receivable to put him back in accounts receivable, put this back in the allowance, and then record the fact that he paid, just like this previous collection, the $333, okay? All right, so now we are going to look at this next section where we are going to see how we came up with the estimate for the allowance account, okay? So there are two, well, first, just to kind of summarize, the things that we're focusing here is on classification of accounts receivable and the valuation. So the valuation is what we're about to talk about now. Accounts receivable are valued on the balance sheet at net realizable value, meaning what we think we're going to actually get from all of these receivables. So which would be the accounts receivable less the allowance would be our net realizable value. Okay, so we value them at net realizable value. Classification has to do with whether it's short-term or long-term. So if an accounts receivable, and it normally is short-term, it goes in the current assets, but if it does happen to be a long-term receivable, then it should go in the long-term section. Okay, so to estimate the accounts receivable, we can do it one of two ways. One is the direct write-off method. Okay, So under the direct write-off method, we are going to write off our bad debts directly to bad debt expense. I don't think they have a, wait, let's see. No. Okay, so we write them off directly to bad debt expense. Okay, the problem here is we wait for them to become a bad debt, and then we write them off when they do become a bad debt, so the matching is not there. So this method is not GAAP. Okay, so the direct write-off method is not GAAP. Okay, but the allowance method, these are going to kind of roll around in your head a little bit. And so, I mean, the thing you want to do is lock down how all of these separate ones work, because what you're going to find happens in this chapter is you have so many different journal entries that they're going to get mixed up. So really the way to do it is to do a lot of, or to do several sample problems. So we're going to do some sample problems today, but remember that I have the answers to a bunch of problems, posted. So maybe try doing them over and over again until you get it straight. Okay, so under the allowance method, you can either use the percentage of sales or the percentage of receivables. Okay, so in the allowance method, you estimate your losses in the period that in a more current period before they actually become bad debts, okay? So this method is GAAP. The allowance method is GAAP. So what do we mean by that? If you're in a company that's required to present your financial statements in accordance with GAAP, you have to use the allowance method unless it would be immaterial, unless your bad debts are immaterial to do it, unless it would be immaterial to do it the other way. Like the place where I worked, we never did have any bad debts really, and any kind of bad debt that might pop out was, going to be immaterial, so there was no bad debt expense estimated. Okay, so the percentage of sales method matches, okay, so in the percentage of sales method, you estimate your bad debt expense based on a percent of sales. It's just like it says. Bad debt expense is estimated based on a percent of sales. In the percentage of receivables method, bad debt expense is estimated based on a percentage of receivables, just like it says. Okay, so what's the difference in those two methods? In the percent of sales method, we're matching our revenues and expenses because we're basing our expense estimate on sales. It matches revenues and expenses better. But in the percentage of receivables method, we're basing it on the total receivables. So we're looking at the receivables to make our estimate. So it matches, it better estimates net realizable value. So you could say, okay, so this is better matching, percentage of sales is better matching, and this one is better net realizable value. So what do we mean by that? Better matching is better for better matching of sales and expenses. That means it's better for the income statement, okay? Better net realizable value, meaning accounts receivable less allowance, that's better for the balance sheet. So therefore, the percentage of sales method is more of an income statement approach, and the percentage of receivables method is more of a balance sheet approach. Okay? All right, so now we'll see how to do both of these. Okay, so in the percent of sales method, it may be that your company, you kind of know that X percent of people are not going to pay. Like maybe maybe your sales are very routine and your clientele is kind of standard, and you just know that of all the people that you sell to, X percent are not going to pay. Does that sound like a realistic thing? What do you think, Angela? Maybe you have like a long-term history of, okay, so 5% aren't going to pay, right? And so when you make a sale, or in the same period as you make a sale, you're also going to record what the bad debt expense is, okay? All right, so now let's do an example of this. This company says 1% are not going to pay, okay? So this Gonzalez company says every time they make a sale, 1% of them are not going to pay. So if they sold $800,000 during the year, and they say 1% of those are not going to pay, then what we take is our bad debt percentage times our sales. That gives us our journal entry, okay? So these two are done two different ways. So what you want to do is take your bad debt percentage, which in this case is 1%, right? Times our sales, which in this case, so let's just do that up here. 1% times 800,000 equals 8,000, right? Okay, so our bad debt expense is 8,000. So we're debiting 8,000, we're increasing our expense by 8,000, and then we're crediting the allowance for doubtful accounts. Okay, so our entry here is to debit bad debt expense and credit the allowance for the 8,000. Okay? Okay, so this is the percent of sales way to do things. So this shows you that our allowance account has increased by 8,000. Our bad debt expense has increased by 8,000, right? So now we're going to contrast that with the percent of receivables method, okay? So under the percent of receivables, what you might do is you say, okay, I have this whole list of people that owe me money. And let's just think about that list of receivables. Some of those people that owe me money, we made that sale last month. Some were 5 months ago. Some were 6 months ago. So these people, we can put them on an aging schedule, and this is what companies do all the time. They say, well, how long's it been since they've paid me, right? Now, if somebody doesn't pay you in the first month, okay, fine, they had a bad month, and they might catch it up the next month. But if somebody goes like 3 and 4 months without paying you any money, what is likely happening? What's likely happening if they haven't paid you in 4 months? They're like blowing you off, right? Yeah. So the longer it goes since they've paid, the less likelihood they really are going to pay. Okay, so we could put everybody up on an aging schedule like this. So here's our list of people that owe us $547,000, and of that, most of this is under 60 days, but there are a few stragglers that have gone on over 120 days. That's kind of a long time, right? Angela says they're not going to pay after that. So what this company has done is said, okay, now we know that this company comes up with a percentage of the 460,000 that's under 60 days. They've said that 96% of them are going to pay. 4% of them are not going to pay. Okay? So they say 4% are not going to pay over the 60-day column, 15% aren't going to pay out of the next column, 20% out of the over 90-day column, and 25% over the 120-day column. So you see how that is? They're getting this increasing estimate based on how many days past due it is. Okay, so does that sound reasonable? Maybe it's based on past history. And so what these guys do is they work out these percentages of receivables. So we calculate, let's say it this way, we calculate the allowance and then we adjust to that number. Okay, so let's see what I mean by that. We've calculated that the allowance in the allowance for bad debt should be $37,650. Okay, so this is our balance. We say that this should be our balance at year end. Okay, we probably have some other balance in the account, right? Because the account's going up and down. Remember with all those entries we make of people being written off and that sort of thing? So what we have to do is, if the account had a zero balance, this is what we would do. If the account had a zero balance, then we would debit bad debt expense and credit the allowance account. But it's most likely not going to have a zero balance unless this is your first year of operation. So what would happen if the account had a credit balance of $800? What kind of balance is it supposed to have? Or maybe not Southern sounding, supposed to have. What is it supposed to have, a debit balance or a credit balance? Our allowance? Allowance for doubtful accounts? Credit. Okay. So it's supposed to have a credit balance, and we want to bring it from a credit balance of $800 to a credit balance of $37,650. So what do we do? Jillian? Okay. 36,800? Yeah, and 50. And 50. Yeah. Okay. Yeah. So that's what we do. Okay. So we adjust to that number. We're going to have to, subtract and see what it should be. So now let's get this straight though. If it has a credit balance, we're going to subtract our total balance. We're subtracting here. But if we don't have that. What if it had a debit balance in there? What if it was an $800 debit balance? What do we do then, Avery?
I'd assume
Add it. Okay, good. Yeah, we're going back to like the number line, right? Do you know what I'm talking about? Like sixth grade number line where it's below zero or above zero. And we're having to move that thing further to get it to the credit balance, right? So if it had an $800 debit balance, then we'd add $36,850 plus $800, right? Okay, in both cases, we're adjusting to that number. Now, in situations like this, I always find when you're making journal entries, you write the entry and then you think about it one more time in your head. What was my balance before I make the entry? What am I going to do, add or subtract if I make this entry? And then what is my balance going to be? Double check yourself after making the entries. Because it matters here whether you had a credit balance or a debit balance. And it could be either one, okay? Okay, so here is this company's situation. Here's what kind of balances they have. Do you know what this looks like? This looks like a test question to me, kind of, right? About the same length as a test question would be, right? So if we have this situation where we have this much in accounts receivable, this much in the allowance account, and we had a bunch of sales, then what would we do if we, what kind of journal entry would we have? Oh wait, you know what I meant to do? What does the journal entry down here look like? The journal entry down here is the same thing, bad debt expense and allowance, right? This journal entry is the same sort of thing, but it's just that you adjust to that number, and that is the number that you use here. So the difference is, here we calculate the number, and that's the amount of our journal entry. On this one, we calculate the number and we adjust it to the number. See the difference? Okay, so, all right, here's our situation. We have all this stuff. What is our journal entry to record bad debt expense, assuming they use 1% of net sales? All right, just forgetting the amounts. What are we going to debit and credit? Debit, bad debt expense, credit, allowance for doubtful accounts. Okay, so assuming you get that straight, then you should kind of eliminate some of the choices in the multiple choice, right? Okay, so now what do we do? How do we know what amount to do? So for the 1% of sales, well, it says 1% of net sales. What do they mean by that? Right. So we're going to calculate 800 minus 50 is 750,000 times 1% is 7,500. We calculated the amount and we make the journal entry for that, right? Okay, so now let's assume, yeah, that's how we got it. Now prepare the journal entry assuming that bad debt expense is supposed to be 5% of accounts receivable. So what is 5% of accounts receivable? You got it, Jeremy? No? Brett, you got it? Okay. %5 of accounts receivable. What you got? Oh, wait, but no, 5%. 5% of 160,000. 8,000. Okay, good. All right, so we got 8,000. So what do? We just, okay, so when we calculate that, we multiply the percentage times accounts receivable balance, right? Or might have to do that several times with all those different percentages. Okay, so wait, let's think about this. We're going to go back to algebra, okay? Algebra 1, pre-algebra, okay? 5% of accounts receivable, make that a word problem. The of means what? Multiply, right? Okay, so this is we're just plugging it in, 5% times accounts receivable, which is 160,000, right? So in the other case, 1% of net sales, 1% times net sales, right? Okay. All right. Oh, 8,000. Now, okay, we're going to stick with you, Jeremy. Is that okay? We'll take our chances, right? Okay, you said 8,000, right? Okay, our allowance account has a balance of 2,000 in it, right? We want to get it up to 8,000. We're going to adjust to the number that we calculate. All right, so we get it up to our entry. We already know what our entry is going to be. Debit, bad debt expense, credit, allowance, right? And we want to adjust the 2,000 up to 8,000, which means our amount is going to be 6,000. Okay, so we're subtracting because they're both credit balances. Okay. All right, so what you don't want to do is make your entry for 8,000, right? That'd be wrong. That's probably going to be one of the choices, in fact, on the multiple choice, right? So don't fall for the trap, okay? You adjust to the amount for the allowance method using the percent of receivables, okay? All righty. So how do we write off an accounts receivable? I think we've gone over this before. How do we write off an accounts receivable? What do? We write off the receivable and we write off the allowance for doubtful accounts. Okay, so there we are. Write off the receivable with a credit, write off the allowance for doubtful accounts with a debit. Okay? Now, assume that he pays that money. What do we have to do, Angela, when he gets religion and pays us? Yeah, so we reverse that whole entry. This one that we did here, this is our reversal, debiting accounts receivable, putting it back in accounts receivable, and crediting the allowance. Now he's paid us. What's our entry for when he pays us, Angela? He pays us cash. Well, okay, you're waiting on me to help you out. Yeah. Okay. Our cash is increasing with a debit. Okay, yeah. So we debit cash and credit accounts receivable. Okay. All right. Now, we've finished that part of the chapter. That is the hardest part of the chapter, really, or the most important part of the chapter, let's put it that way. Now, let me just skip through this notes part kind of fast. Remember notes, the difference in notes receivable and accounts receivable is that notes, accounts receivable are oral promises to pay, and notes receivable are written promises to pay. So something is signed, and notes receivable have they're either interest bearing or they have a zero. They're zero interest bearing, which means that the interest is included in the note. Okay. Usually you have notes receivable with high risk customers or new customers that you're not sure about, or if you're loaning something to somebody, a related party of some sort. Or if you're selling something really big, a big ticket item, like a property, plant, and equipment, or a diamond ring, or an airplane, or something like that. Okay, so this is just a little bit about how the interest rates affect the notes. Short-term notes are recorded at face value, but long-term notes are at present value, which takes into account the interest rate of the note versus the market interest rate. So this is the same situation. If the amount of the note, the stated rate, differs from the market rate, you're either going to have a premium or a discount. Okay, and this shows you how to calculate the receipt of the note when there is an interest rate imputed in, or an interest rate in there, which in this case is 10%. You're going to look it up on the table and get a factor and calculate the present value of the stream of interest payments that you're going to get, and the present value of the principal, which in this case, since the interest rate for the note, the market interest rate is the same as the stated rate, it's at the face amount, which is $10,000. Those two things add up to $10,000, okay? All right, but if it's a zero interest-bearing note, for instance, you'll get these two amounts and impute the interest and record a discount on the note. And as time passes, you're going to amortize the discount. Okay, I'm going over this a little bit faster because this is not quite as important. Here's how you amortize the discount, okay? In year one, you're going to amortize the $694. See, this is on the table here. And then in year two, it's $757. So the carrying amount of the note changes until it gets up to the end of year three. The note is on your books at $10,000 because that's what they're going to pay you is $10,000. Okay. And this is an interest-bearing note, kind of the same thing. All right. Now I want to get to, we're not, let's see. Okay, I think we're going to go ahead and do the problems that are more important right here. And that is brief exercise 2 through 5 we're going to do. Okay, so how about half of y'all do brief exercise 2 and the other do brief exercise 3? Who wants brief exercise 2? Why don't you 3 right here, Avery, Jeremy, Brett, do 2, and you guys in the back do 3, okay? So what kind of situation do we have in this problem? Avery? Yeah, like which one of the slides pertains to this?
The growth method?
Yeah. Okay, so our choice is, what we're talking about here is the sales discount and how to recognize the sales discount, right? And we can either use the gross method or the net method, right? So under 2, they use the gross method, right? On 3, they use the net method, all right? So on 2, we use the gross method. Let's see, you guys had the gross method, right? Okay, so what we did was we made some sales. We sold $50,000 worth of stuff. What's our normal entry Avery, when we sell something on credit?
Debit sales and credit accounts receivable.
That's what we do. We debit sales and credit accounts receivable.
Which one, for a regular one or for this problem?
Right, any kind of sale. Any kind of sale that we make, just forget this problem for a second. If we make a sale, sales normally have a what balance? Credit. So we want to credit sales, right? Okay. So we're going to credit sales and debit.
Accounts payable.
Who owes us money? Okay, yeah, I'm getting you confused, right? Okay, he's going to help you out. Accounts receivable, right? Any kind of sale we make, that's what we do. If it's a credit sale, we're going to debit accounts receivable because they owe us money and that's a debit account, an asset on the balance sheet, right? And we're going to credit sales. Okay, in this case, now they're using the gross method. It says they made sales of $50,000. We're using the gross method. Okay, now you can take over again. What is the amount of our journal entry under the gross method? 50,000. Yeah. Okay, so we're just going to make the entry for 50,000 because we're under the gross method, right? All right, now whenever they pay us, just tell me well, let's switch to Brett. Brett, what's our normal entry when somebody pays us money? What accounts do we use? Debit cash and credit accounts receivable. Now these guys though paid us on June 1st they paid us on June 12th for a sale made on June 1st. How many days is that? 11 days. And the terms are 3/15 net 45. What does that mean?
3% discount in 15 days.
3% discount if they pay within 15 days, which they did. So therefore, we want to figure out how much what's the discount that they get to take?
$1,500.
Okay, so the discount is $1,500 and they paid us how much? $48,500. What do we do with the $1,500?
Credit sales discount.
Credit sales discount. And then what's our accounts receivable? What do we do there?
You credit it for $50,000.
50,000. How does that look?
That's not right.
Debit sales discount. Okay, gotcha. Okay. Debit sales discount. Because sales discount is, it decreases our sales, right, which were a credit. Okay, so we debit sales discount, right? Okay, so are we done there? Yeah. How did we get that 1,500? 50,000 times 0.03, right? Okay, yes?
So for that problem, we have to do the top journal entry too?
Yes.
Let's do both of those.
Yes. You have to know how to do both of these journal entries. All right, so now let's do the net method. So you guys at the back were in charge of the net method. Angela, when you make any kind of sale, what accounts are we going to debit and credit? Debit accounts receivable and credit sales. All right, so now under the net method, what's going to be the amount that we debit and credit? 1,500? We're going to debit and credit it for the net amount, which is, okay, so let's just think about this. Our gross amount is 50,000. The amount of the discount is what you calculated, 1,500. The net amount is $48,500. Okay. All right, so you got that? Okay, so now our journal entry, Angela, is going to be debit accounts receivable for 48.5 and credit sales for 48.5. See, under this method, we're assuming that everybody's going to take the discount, and we're just going to record it net. Under the gross method, we're more or less assuming nobody's going to take the discount, or we're going to record it later. We'll wait and see whether they do, and then we'll record it.
So, gross has 2 parts.
We're not done with this one. Yeah, we're not done with this one. Okay, so this is when we made the sale. Okay, so yeah, it has 2 parts. This is the sale, and this is the cash is paid. Here we've recorded the sale, and now we're going to record the cash being paid. All right, so in this situation, they received full payment on June 1st. No. They received, I did that again, full payment on June 12th for the June 1st sale, which that's how many days? 11 days. So were they in time to get the discount? Yes. So how much did they pay? 48.5. So our cash is 48.5. What else do we do? When people normally pay, credit accounts receivable, how much is our accounts receivable? 48.5. Okay. Now, one important fact, see, we established this accounts receivable here by debiting it, and we credited it here for the same amount, right? Up here, we established the accounts receivable for $50,000, and we credited it here for the same amount, see? Because we want to wipe out our accounts receivable. They paid everything, right? So it was just the fact that we had accounts receivable established for the net amount here. Now, can we just see what is going to be on our income statement under these 2 methods? Remember how I did that before? On our income statement here, we have sales of $50,000 less sales discounts of $1,500, sales discounts. We subtract that. So our net amount on the income statement, sales at net, are 48.5, right? Down here, sales at net are 48.5, right? So they're the same thing. It worked out the same way netted out on the income statement, and it worked out the same way on the balance sheet. In the end, everybody paid and we're all down to 0, right? So that is the gross method and the net method. All right, does that seem like it would be easy to get twisted around in your head, Angela? Yes, okay. So what do? Do it over and over, right? Until you get it right every time, until it's just second nature. Okay, so this one, this kind of journal entry, well, I don't guess I need to say that again, do I? Jillian? No, okay. All right, we won't say that. What was I going to say, Angela? Oh, yeah, exactly. We're pretty sure about that at this point, right? Okay, now we're going to look at number 4. In number 4, what kind of problem do we have here? Let's do the same thing because we have number 4 and number 5. Let's have you 3 guys in the front do number 4 and you 3 guys in the back do number 5, okay? Okay, so it looks like we're doing pretty good on this one, right? At least on the number 4. How about we do number 4 and then we'll think about number 5 in a minute, okay? Is that all right? All right, so what kind of problem do we have here, Avery? Okay, yes, we have a bad debt expense problem where we have 2 ways to calculate it, which are yes, okay. All right, or we have, percent of sales and percent of receivables. Okay, so number 4, which way do we use? Sales, okay. So they use a percent of sales. All right, which is this one, right? This is what we're talking about. Okay, so if we use on number 4, percent of sales, the situation is they give you a net sales amount, balances in accounts receivable, balances in the allowance for doubtful accounts, etc. What they want is the entry to record bad debt expense. Not thinking about the numbers, what would be the entry to record bad debt expense?
Debit, bad debt expense, and credit, account.
Okay, yeah, debit bad debt expense and credit the allowance, right? So now all we have to do is figure out what the amounts are. So let's go to Brett for that. So Brett, what do we do if they say that it's based on 2% of net sales?
You multiply net sales by that percent.
Okay, excellent. So net sales were,
1,400,000.
right. If they might have had some kind of other number in there to trip you up that you had to subtract out, right, to net it, but we don't in this case, right? They just gave you flat out net sales. So 2% of net sales is how much?
28,000.
28,000. And would that be the amount of our entry or what?
No. Or would you? I don't know.
You would add the 2,400.
Add the 2,400. So let's review. For a percent of sales, this is the income statement method. We multiply bad debt percent times sales. Then what does this mean? Yeah. That's the amount of the journal entry, right? In this one. Okay. So the amount would be 28,000. Right? See here, we did 1% times 800,000 is 8,000. That's the amount of our journal entry. These are done 2 different ways, right?
So when it's for net of sales, you don't subtract or add out the difference?
Here's our example here. So 1% of credit sales becomes uncollectible. If net credit sales are 800,000, then we multiply it times 1% and we get 8,000, and that's the amount entry. And so that's why this thing is important. This amount, that's our entry, right?
I just got confused on what were we subtracting and adding out?
Oh yeah, that's maybe what you're coming up with that next.
Okay, so that's just net.
On this one, okay, so let's review that. On the percent of sales, the calculated amount is your entry. That's the easy way to say it. On percent of sales, the calculated amount is your entry. Okay? Remember we did percent of sales first. The calculated amount is our entry. Okay, so on the percent of receivables method, which is number 5, right? How do we know number 5 is percent of receivables? Because it says they assume that 10% of receivables will be uncollectible. That's the percent of receivables method. What do we do then? The calculated amount, you adjust to the calculated amount. So on the percent of receivables method, you adjust to the calculated amount. On the percent of sales method, the calculated amount is your entry. Okay? All right, so let's see. Jillian, are you doing this one? What's our normal, on number 5, what is our normal everyday, what accounts do we debit and credit? Just the accounts for bad debts. Yeah, debit bad debts and credit allowance for doubtful accounts. See, this is the same thing, right? It's just the amount that's going to be different. So you need to calculate the amount that you want bad debt expense balance to be, right? And how do you do that? We're doing the percent of receivables, right? So in this case, it's 250,000 times 10% equals 25,000. Now, is that your entry? No. What do you do? Which is 2,400, right? To get 22,600. Okay, so yeah, we want to have a credit balance of 25,000 in the account, but currently we have a credit balance of 2,400. So what do we need to do now? We're going to, yeah. Okay, 22,600 and credit allowance for 22,600, right? So we make the adjustment, we're going to adjust to the calculated amount. This is how much we need to get up to the calculated amount in that account. There's a B part to this. Did anybody see that?
And then just to be like, so if there was, like, I don't know if we've ever run into this problem.
Yes.
Ever negative.
If it ever had a balance of debit balance of 2,400, you'd add it. Yeah. Okay, so now this was the A part. Now we have a B part. Instead of 2% of net sales, assume that they have an aging schedule and they want to adjust everything to 24/6. So Kyle, I don't know if you got this far, but let's just go with it. What is our entry going to be, debit and credit, for what kind of accounts do we use to do on the next page? They did an aging schedule and they say bad debt, they say they're going to estimate uncollectible accounts at 24,600. That's what they want the balance to be. All right, so what are our accounts that we use to do bad debt expense?
Allowance and accounts receivable?
Okay.
Or, I don't really know.
Angela? Okay, what accounts are we going to use to record bad debt expense? What are we going to debit and credit? Yeah, bad debt expense and allowance. See, we got a pattern going here, right? Okay. Bad debt expense allowance for all of these, right? Okay. Now, should we go back to you, Kyle? Okay. We want the balance to be 24,600, right? And so how do we get it there? We're still in that same situation. 24,600. This is what we want the allowance account to be. So in other words, this is our estimate. How do we get it there? Y'all can whisper to him. Who wants to whisper to him? Jeremy? Okay, whisper to me. Okay. Okay, where'd you get the 2,000 from?
24,600 minus 22,600.
Oh. Yeah, ignore this. We're not doing this part anymore. Now we're doing a whole nother problem. And we're just pretend we're on a whole nother problem. But, okay, let's go back. They had sales of $1.4 million. They had accounts receivable of $250,000. They had allowance for doubtful accounts of $2,400 credit. And they want $24,600 in the account. Jillian? So what did you do? Ooh. 2,400, which is in the account now, right? We're adjusting to that amount, right? We're adjusting, the account has a balance of 2,400 and we want to get it up to 24,600, so it's going to take 22,200. So the amount here would be 22,200. Okay? Now, what has happened to our brains today? We've turned them around in circles, right? Everything is swimming around, right? Am I right? Yeah. Okay.
I just got a question how, for 5A, how you can subtract bad debt expense from a different account.
Okay. All right, so I'm not getting the question.
You see what I'm saying?
No. No. Okay, so we're doing the percent of receivables method. This one.
Yes, no, I just don't.
Okay.
Like how you subtract, okay, for.
We're trying to bring the allowance account, this account,
Yes, no.
up to this number, right? Wasn't this our number? 25,000? Okay. Assume that 10% of accounts receivable is going to be uncollectible. So how do we get this number? 10% of our accounts receivable, 250,000, is going to be uncollectible, 25,000. So we want our allowance account to be 25,000. Now the allowance account has a balance of 2,400. Allowance for doubtful accounts has a $2,400 credit. So what we're doing, let's look at it like this. Here's our allowance account. It had a balance of 2,400 credit. We're going to make this entry of 22,600 credit. This is our journal entry, and this is our balance. So what's the ending balance in the account? 25,000. That's the ending balance. Credit, which is what we want. So what's on our balance sheet now is total accounts receivable of 250,000 less allowance for doubtful account 25,000. 250,000 less 25,000. That's what it's on our balance sheet now after doing that. Okay, so now what part? What are we missing? Don't know?
I just would think the bad debt expense would be 25,000. You're saying why isn't bad debt expense 25,000? Yeah, why is it 25,000 and why are you subtracting that number from a complete different account?
Okay.
Like,
We are calculating the allowance account in this problem. In this part of the problem, we are the percent of receivables method. The allowance account is the one that we're focusing on. We're focusing on the balance sheet. On this problem, we're focusing on the income statement. That's kind of the difference. Bad debt expense, we're not really, it's just whatever it ends up being. We're not really calculating bad debt expense. We're calculating the allowance account. Does that? Okay. Okay.
In the income statement, because the bad debt expense, the expense is on the income statement.
Is on the income statement. And we're we're basing it on sales, which is on the income statement. So we're calculating based on sales. And so we really are kind of calculating the bad debt expense on this one. And it's more like we're calculating bad debt expense on this one and allowance account on this one. Yeah, that might be a way to think about it. Okay, what else on these? So,
For real quick for B, just because that's where I ended up getting confused.
okay,
So all you do is take that uncollectible account, which is 24,600, and you already have 2,400
Right.
in the
right,
allowance for doubtful accounts.
right,
And it's credited.
yeah.
So
You subtract it since they're both credits, yeah,
And if
yeah.
it was debited, you would add it.
Add it,
Okay.
yeah. So these are the same problems right here, basically. It's just on this problem, they gave you this number. Here you calculated the number. You had to calculate the 25,000 here. Here they gave you 24,600. That's really the only difference.
The only thing, that's like the thing, the debit and credit, it's not hard, but subtract and add, like, that's why I'm like, hold on.
Well, and so the thing is, here, if this number right here had been 2,400, a debit balance, then
Need to add,
you'd need to add a bunch more here. Yeah. So what would our number be?
what does that say,
2,400 and 25,000.
You would need to add, 20, 23.
We have a debit balance and we want it to be a credit balance. Pretend like this is less than zero and this is more than zero. 27, 4. We have to add these two numbers to get this number. Angela, do we have that? Does that make sense? Looking at it this way? Okay, or you could look at it this way. Here's zero, here's $2,400 debit. We have to get all the way past zero to 25,000. So we have to go this far of 2,400 and then this far of 25,000 to a total of 27,400 journal entry to get to 25,000. Okay? All right.
Because it's considered, when it's a debit, it's considered negative, basically.
Right, basically. Yeah. Opposite of its normal value. Yeah. Okay. So, we did a lot today. We didn't really finish this chapter, but we finished the most important stuff of the chapter. And next time when we come, we're going to kind of hit the rest of the chapter that's really important, but we're going to have to skip over it a little bit. But I'll tell you what's really important. How about that?
So all the stuff we did right here is all chapter 7 homework?
There might,